Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. The gold price today on Friday, March 14th, 2025, it briefly hit $3,000 an ounce for the first time in history. It's corrected a little bit. The silver price also, I think, hit above $34 briefly. It's also corrected a little bit down to $33.77. We have a returning guest. He is a money manager and also a newsletter writer for many years. He's been covering gold stocks, so we have him at the correct time, I think. One of the few industries out there that is actually growing free cash flow in this very difficult U.S. economy and macro environment. Adrian Day of Adrian Day Asset Management. Thank you for joining me again.
Well, thank you, Jason. Thank you for having me.
Now, Adrian, you've been covering gold stocks for many years. Have you seen this type of free cash flow growth out of the sector before?
No, not really. This is pretty astonishing because when you go back to the last major move in golds, which was, 2000 to 2011 with a bit of an interruption in 2008, costs were going up. For some periods, they were going up faster than the price of gold was going up. And so you didn't see this huge increase in free cash multiple. In free cash. This is a very, very unusual period. You've got the gold price moving up, as you said in your introduction, to record highs. And it's been going up for the last 2 years, as we know. But you just look at the last year, it's gone up meaningfully quarter after quarter. And yet you look at the major cost inputs, look at the cost of energy, particularly oil is the number one cost input for running a mine. What we call the commodity currencies, but that's the currency in which mines are located. So if you're a Canadian company with an Australian mine, the Australian dollar, and so on. Obviously, the currency valuation makes a big difference to all of your local costs, everything from building the camp to feeding your workers. And we're just, if you look at the cost of inputs today relative to, say, 2011, they are all meaningfully less. And so over the last 12 months, over the last 15 months, all of the major mining companies, every single call I've been on, they spend a lot of time talking about their cost initiatives and how costs are going up and how they're going to moderate the cost going forward. But the truth is, I would really like one of those companies to come out and say, well, yeah, costs went up by 4% in the last quarter, but the price of gold went up by 10 or 20%. And our margins have expanded. So yeah, you're absolutely correct. This is an unusual period, and that's from that point of view.
Yeah, I wanted to draw on your experience because you've been covering gold stocks for a very long time and you've been through many different cycles, bull market, bear market, from what I remember, even in the past bull market cycles, Adrian, the costs also rose at a rapid rate. This is one of those rare instances. The other ones, I think, was from like 2020, 2021, where you did have a spike in the gold and silver price and the energy prices were flat or headed down. The oil futures price, I think, even went negative briefly, although like for most producers, it wasn't actually negative. But
Sure.
that was still what, a 12, 18-month window for the gold miners where they had really good free cash flow margins. I would argue that these margins are better that are going to come out for Q1 numbers. We've seen some of the earnings releases. Alamos Gold was one just in the last week or so. They had excellent earnings. And then even Barrick Gold, Newmont Mining, and First Majestic Silver posted good profit margins and free cash flow too.
Yeah, no, absolutely. The period, over COVID was a much shorter period, of course, as you mentioned. And also, as you mentioned, I don't know a single mining company that went to buy their oil and was given and was paid to take the oil away. So it still cost them money. But yeah, that was a similar period, but a much shorter period, of course, for the mining stocks. I mean, you've had 4 quarters now where pretty much every mining company around has seen their cash flows go up quarter on quarter. And it's not just cash flows, it's also free cash flow because the mining sector today, by and large, they have much stronger balance sheets today than they did back in 2011. And so an awful lot of this increase in the price of gold is actually flowing down to the bottom line. It's real, genuine, free cash flow because the debt payments are not so high.
Now, for industries, are the gold miners like probably the only industry, or one of the only couple industries out there right now that is actually growing their free cash flow?
Well, I don't know that they're the only one growing. I can't say that. I haven't looked at that, but I can say that the gold mining industry, of all of the industries in the US, has the highest free cash flow growth.
Wow,
Uh,
that's
past
very
12
impressive. I cannot remember any, and I've been doing this for almost 15 years, and you've been doing this longer than I have. I can't remember a period of time where that was true.
Oh, absolutely. No, you're absolutely correct. And at some point, generalists are going to have to notice that. And I think we're just getting to the point now after the S&P. The S&P actually went into, technical correction territory yesterday. With the S&P having a correction, with the leaders of the S&P, the tech stocks falling, I mean, dramatically over the last 6 weeks. Look at Nvidia, look at down 30%. Look at Tesla, lost over half his value. I would think that generalist investors, particularly value investors, are going to have to start taking notice of the gold stocks.
And the GDX, which is the gold miners ETF, that's still at a little over $43 in change right now when we're recording this interview. It was at around $40 only a week to 10 days ago. I mean, Adrian, if you're going to look at like the all-time highs for GDX, that was at $64 back in 2011 at a much less gold price. So you talked about revaluation, re-rating, a higher free cash flow multiple. If the miners in continuing quarters, what in Q1 numbers, we're not done with all the reporting yet for all the miners yet. I think for Q1, Q2, Q3. I mean, if they can put a couple of these quarters together, 2, 3, 4 quarters in a row of good free cash flow or growth in free cash flow, I mean, that's going to cause what, a multiple re-rating, you think?
Yeah, typically, as you know, when the price of gold or the price of the commodity, whatever it is you're selling, but when the price of gold moves up, the multiples of gold mining stocks expand. That's typical. What we've seen this time is really a contraction in the multiples, which is really quite astonishing. I mean, I'm just looking at Agnico, for example. According to Bloomberg, their price to cash flow is 12 times for this year. You go back 4 years, it was 16, and 5 years, it was 15. You look at their price to free cash flow, which is more significant, of course, or in my view, it's more important. According to Bloomberg, is 27 times for last year. Now, it's obviously going to be lower for this year, but they don't have the estimate in yet. That compares with 40 times in 2022, 49 times in 2021, 39 times in 2020, et cetera, et cetera. So yes, you've actually had multiple contraction, even as the price of gold is going up and even as the free cash flow is increasing. Very unusual, very unusual.
Yeah, I agree. The market will start to notice this. There will be some asset rotation. Also, if you're running these companies like an Agnico Eagle with the free cash flow, you have all these extra options. Agnico Eagle did under the radar acquisition of a junior. They bought all the surrounding land package, for Canadian Malartic, or around that mine with one of the juniors. You also saw Alamos Gold, excuse me. Alamos Gold do another under the radar acquisition. What they bought the Mangino mine next door to one of their producing mines from Argonaut Gold when they got into financial trouble. The market has really liked these acquisitions lately.
Sure. No, you're right. I mean, most of the larger companies are saying that paying down debt is their first priority, over increasing dividends and buying back stock. Obviously, good acquisitions, unless a company is bankrupt, doing a good acquisition should always be the first use, the highest priority use of cash. But after that, most of them have been paying down debt. And the truth is that the vast majority of them are in very, very strong situations with their balance sheets. In fact, the XAU, of course, includes the royalty companies, which typically don't have a lot of debt or any debt. and typically have a lot of cash. But nonetheless, the XAU is actually in a situation today that it has positive cash. And that's very unusual because, mining is a capital intensive industry. Normally, you would expect in a capital intensive industry, you would normally expect companies to have debt. That would be normal. But, you can look at most of the companies today and they have very, very low debt, net debt, that is, net debt. So a lot of them will carry debt, but have cash on the balance sheet. But most of them have very, very little net debt. And the ratios are extremely low. So the industry is in a very, very good shape.
And for our listeners out there, Adrian's referring to the debt ratios, like the debt covenant, debt to cash flow, debt to equity.
Debt to equity, and then also their ability to pay back debt. So the quick ratio, for example, they're all in, very, very solid positions.
Well, I think the miners, actually, the producing gold miners, so like your lower cost producing gold miners, they benefited from the industry being starved of capital. So they had to focus on running lean and mean. They couldn't do as many bad acquisitions. They had to focus on optimizing the mine. They couldn't waste as many funds because the cost of capital was so high. So over the last, 5 years, they had to focus on being more efficient as compared to the past, bull and bear market cycles where they wasted tens of billions of dollars in bad acquisitions.
Absolutely. And you remember back in 2011-12, you remember that, 3/4 of the CEOs of the mining companies were fired because of stupid acquisitions, overpaying for marginal assets. I think the industry remembers that. If I was a CEO, I would remember that. Now, I'm a cynic, and I have no doubt that when we get to $5,000 gold and when the stocks are trading at ridiculous multiples and they've got stacks of cash on the balance sheet, I have little doubt, I should say, but all of the sort of aggressive fund managers are going to go and talk to the CEOs and say, you ought to buy this, you ought to buy this. Why are you sitting on cash? I mean, I remember a question once, it was to Franco-Nevada actually, but it wasn't. It was to Barrick. And they said, you've got so much cash on your balance sheet. Why don't you do an acquisition? And the answer was, anything in particular or just an acquisition for the sake of an acquisition?
Oh, you mean the Barrick Gold CEO actually said that?
Yeah.
Wow.
So, the truth is these companies do get pressure when they have a lot of cash because investors typically, to me it's ridiculous, but investors typically don't like companies having a lot of cash. They want them to go out and do something.
It's growth for growth's sakes. But so you mentioned the institutional investors, so like the hedge funds, the pension funds, the institutional investors. Adrian, it is also the investment bankers. I've just heard off the record stories that some of these investment banks in the US and Canada, some of these larger companies in the mining industry, when they are flush with cash, they will call nonstop offering them cheap debt to do leverage buyouts. So the pressure
of course, all the time. And I can't tell you the number of times, and this is more smaller companies, but I can't tell you the number of times smaller companies, when I say, why are you raising money now? You don't need it. And you're oh, well, it was offered to us. That's not a very good reason
to
dilute your shareholders.
Do you think they told that most of the shareholders that, or just told you because you're an industry insider?
Yeah, I don't know.
Probably not going to go tell a bunch of retail shareholders that we just diluted you just because we could raise the cash and we did it.
Yeah, it's not on the website.
So, what do you think could derail this free cash flow growth? Because you've been through bull markets, bear markets, miners underreporting. Would the miners then start to have to process the worst grade ore that stockpiled that they would never process, that's just sitting there? Would they start to put that through the mill? Would it be governments raising royalty taxes, bad acquisitions? What do you think could derail the gold miners then from not producing these good profit margins and free cash flow?
Yeah, no, excellent question. I do think when the price goes up, miners will tend to they'll tend to at least blend in a lower grade ore. And that's not bad. That's sort of sensible. When the price is high, get some of the ore that you couldn't produce when the price was lower. But that's a pretty small part of it, I think. Yeah, you're going to see a lot more taxes and royalties put on by governments around the world, frankly.
So you've visited some of these mines. For our listeners out there, used to do a lot of site visits. Are there a lot of these mines that just have like the worst imaginable ore stockpiled, or do you think that that's overblown? Because I've heard that like some of these mines like literally have an insane amount of the worst grade ore, and when metals prices get to a certain level, they're willing to like destroy their margins and throw that into the mill.
Oh, no, I wouldn't exaggerate it too much, to be honest. I think it's more a matter of let's go to the, lower grade ore while it's still profitable. I don't think it's a matter of going to really low grade stockpiles and just destroying your margin. But again, it makes sense if you're running a business, over a multi-decade period of time, and if you've got a deposit, a long life deposit that's maybe 10, 15, 20 years, I mean, it does make sense to actually produce the lower grade, when the price is high. I don't see anything particularly wrong with that, but I wouldn't exaggerate it to the point that companies are just going to destroy their margins completely. No.
Now, producing senior and mid-tier gold miners like Agnico Eagle and Alamos Gold, their share prices have not crashed when they've done acquisitions basically next door to producing mines like Mangino with Alamos Gold, and then the market rewarded that, I believe. And then also the land acquisition we talked about next to Canadian Malartic for Agnico Eagle. Do you see any other potential good acquisition targets for some of these mines that are not producing but are right next door to a producing miner for a senior or mid-tier?
Yeah, no, absolutely. I mean, you mentioned Agnico, and another one would be Probe, for example. I think I won't say inevitable, nothing's inevitable, but
Yeah.
it's pretty clear that at some point in the future, Agnico will buy Probe. But that's just an example. That's
Where is that mine?
Sorry, Probe Mining. It's a good deposit in the same area. It goes with the same, philosophy of filling a Malartic mine, but they don't have to be in any hurry to buy it. That's the thing. And, so Probe in the meantime, and I'm using Probe as an example, Probe in the meantime has to continue spending money to advance a project. They can't just sit there saying, well, we're not doing anything. We're waiting until Agnico buys us. I'm just saying I think that will be the end result. But in the meantime, they will continue advancing the project. That will mean they've got a good balance sheet, but it will eventually mean, raising more money, and being prepared to put it into production themselves if Agnico, or someone else for that matter, doesn't step up to the plate. But I think there's a lot of situations like that. But I think investors, and you can see it at Red Lake, for example, you can see it in many places, but investors tend to always think that these acquisitions will come sooner than they do. I mean, the senior is not always looking to buy at the lowest possible price they can. They're also looking to see deposits being de-risked geologically, but de-risked with community relations as well. And so they want deposits that are completely de-risked. So that, first of all, they'd rather pay up for a de-risked deposit than buy it before they've got all the permits and all the social license and so on at a much lower price. And secondly, it's also a matter of timing for the company. Agnico, again, to use them as the example, right now, they're not in a great hurry. They don't have a great urgency to go and buy more stuff to fill Malartic. They've got a backlog of their own deposits, plus, as you say, the ones that they've just acquired, or the one they've just acquired. So, they've got sufficient ore to feed that mill for a while. They don't have to go out and buy anything else.
Yeah, I agree.
So I think, we always tend to expect these things to happen sooner than they do.
Well, you also have Barrick Gold and Newmont Mining, and they have other projects that they want to develop. What they have the joint venture in Nevada that they can expand, or Robertson Mine Cortez Complex, what over the next couple of years that just got permits. So they're going to develop that. That should have been developed decades ago, and that's going to go into construction soon now that they have the permits. So they have other projects, what other brownfields projects that are next to existing mines that they could.
Absolutely. Absolutely. And there's other things in Nevada that the Nevada Goldfields or Barrick might buy, could buy, perhaps even should buy. But as you say, they've got enough that they own already, but they don't have to go and do it anytime soon. And maybe the other company will blow themselves up and they'll get it cheaper.
Well, also, like if they invest in brownfields expansion, like you said, next to an existing mine, they don't have to spend billions of dollars of capital expenditure to build a mine out in the middle of nowhere. So they just add on to the existing mine or expand a mill, and then that could get a quicker return on investment.
Sure, absolutely. And the social license is normally already there. The permitting is easier for brownfields, et cetera, et cetera. Yeah.
Now, in terms of countries, do you think that Argentina is going to be one of the top new mining countries where we're going to see a lot more capital investment and capital expenditure, especially with that new tax rebate program that they have for the next couple of years for 500
Yeah,
million?
I think it's definitely, well, it's definitely turning, no question about that. And I think over the next few years, so long as, they retain an investor-friendly government, and we don't see them going back to the Peronistas, yeah, I think that could be one of the most attractive areas. First of all, they do have great deposits, both in gold and copper, as well as lithium and other things. Secondly, because of what we've seen over the last, well, really over the last couple of decades, it's been underexplored. So there's a lot of potential there. The big thing they have to do, obviously, the biggest thing is to get the currency freely trading so that when companies make profits, they can freely export their profits. They can freely take the profits out of a country. That's the really big thing. And to me, that's much more important than a government credit or tax waiver. And that'll come. I mean, that's coming. Malay's already said it's on his agenda. But yeah, no, I think you're absolutely right. And of course, let's not forget in Argentina, as in many other countries in the world, Canada, US, or whatever, the provinces do have a fairly important say in what goes on with mining. So obviously, as you know, some provinces are much more mining friendly than other provinces.
Now, you
But I
just went
think
to
I
the
think we're going to see a lot more countries a lot more companies decide to take a look at Argentina. No
Yeah,
question.
at least for a couple of years, I think there's a good window there. I think that Argentina is going to be one of the beneficiaries of a higher metals price and their tax-friendly policies for investment for the next couple of years. I think for $500 million or more, I think there's a huge tax break if a mining company makes an investment into a mine and starts construction in the next couple of years. I think before 2027 ends.
Yeah, but remember, of course, that for companies like Barrick and Newmont, big companies, especially if they're looking, or tech or whatever, especially if they're looking at copper, you're looking at many decades. But you're also looking at maybe a decade before the thing even gets into production. And so these companies are going to be a little more cautious on the political situation than, say, a junior that's just rushing in to do some exploration. They want to have they want to be fairly secure in a belief that the political situation is going to be good for the next 20 or 30 years. And so they're going to be a little more cautious at investing hundreds of millions of dollars.
Now, you just went to the Vancouver Resource Investment Conference and also PDAC up in Toronto. Do you think that the U.S. with Trump in the White House and a Republican slight majority in Congress for Republicans, do you think that that's going to open up mining in many different states in the U.S., say like the Resolution copper and gold mine in Arizona or some of these other projects in Alaska? Is the permitting process going to be fast tracked now because of the political landscape changing for some of these copper and gold mines?
Yeah, absolutely. I mean, at PDAC, I heard several stories from, I'd say, half a dozen CEOs of juniors, we're talking juniors here, saying that the permitting was already moving much faster than it was last year. One company told me they've been waiting for an exploration permit for a drill permit for 9 months, was it, or 10 months? And within a week after the new administration in the US, they got a call from the office saying, you're looking for a permit, aren't you? Why don't you come in? I think we can sort it out. And they got the permit that afternoon. So there's no question that there's a lot of, it's coming from the top and it's being pushed into every regional office to speed up the permits. Now, that doesn't mean that highly controversial things like Northern Dynasty or like Resolution, that doesn't mean that they're going to see permits next week. But it does mean that for most projects, things are going much, much faster. And even for those two that I mentioned, you're going to get a serious, rational look at it.
And you're talking about Northern Dynasty. That's the Pebble project in Alaska. That's an insanely large copper, silver, and gold mine. But there's, I think the environmentalist lawyers, the EPA, I mean, they've been fighting that thing. I've been covering gold mining stocks since 2008 or 9. I mean, they've been fighting that since then. So, I mean, the odds are that's one of their main targets to fight to block that mine.
Sure. And I don't want to talk about Northern Dynasty specifically because I'm not so close to it. I'm just saying that things like that, we shouldn't expect them to get their permits next week. But they will at least have a rational, a rational review. And the same goes for Resolution.
Do you think there's any specific states then that will benefit then from Trump in the White House and Republican Congress? Or do you think it's case by case then?
I mean, I think this is coming down from the White House. It is being pushed down to all regional offices and all states. But I mean, clearly states like Alaska, Idaho would be a good example of one that will benefit. I mean, those are the two that spring to mind, but I think also Montana, Wyoming, all of these states will see more rapid permitting, I think.
Yeah, because in the past, wasn't it really difficult to get permitting for a large open pit copper and gold mine in the US? I mean, it's like pulling teeth here, even though you're not doing like using insane amounts of chemicals compared to what rare earth mining or uranium mining.
Yeah, no, absolutely. I mean, there was always something, whether it was an environmental issue, whether it was, a native rights issue, historic land, whether it was, too close to town or the roads went through a town or whatever it was, that there was always, a lot of stumbling blocks or that's not even to mention turtles and endangered insects. So, yeah, the time frame was just automatically was absolutely too long. And what most of the people in the mining business tell me is that it's not that they don't want any environmental reviews. They just want the things to be done more rationally and more quickly.
Well, also, like you think you have everything, all the permits, your T's crossed and your I's dotted, and then these environmentalist lawyers or the EPA come in and change the rules. There's additional lawsuits. They intentionally drag this out for years. This has been going on in the U.S., unfortunately, for a lot of mining companies for decades now.
Yeah, and I think that's what's going to stop. That's what's going to stop under this administration. In fact, it's already stopping. I've heard so many anecdotal stories. Specific stories is already stopping.
What are your thoughts on some of the silver acquisitions? Do you think that we're not going to see a lot of development of silver mines because of the byproduct? Because we've seen some pretty sizable silver acquisitions with Coeur d'Alene Mining and First Majestic Silver recently. Do you think those are just to replace reserves, or are they actually looking at expanding massive silver production soon?
Yeah, a bit of both. I mean, the truth is there simply are not that many good primary silver mines or deposits, developmental projects around. So, I don't, it's difficult to envisage what we might think of as a silver rush anytime soon.
Oh, you mean the best silver deposits left are like byproduct stuff?
Yeah, I mean there are very few primary silver mines around. Most silver mines, as you know, most silver produced is byproduct. But I mean, the companies that are, so you've got Pan American, for example, has a couple of very, very large undeveloped silver mines, as you know, the one in Guatemala, Escobal, and then Navidad in Argentina. So they don't necessarily need to be on the lookout to acquire more. They've got two very large ones that they need to focus on getting into, getting permits and getting approval. Yeah, I mean, I don't think First Majestic was looking to replace reserves so much. They've got quite a few reserves, or at least they've got a lot of expansion potential at what's the name of the mine? Sorry, San.
Are you San Dimas, the one
Yeah, no, the other one. I mean, they've got
Las Chispas or Las?
No, they've got the Ermitaño deposit that's next to the mine, and next to that they've got the Ermitaño West. And then south of that, they've got Kumababi, but they haven't even really started exploring it. So I'm saying they've got a lot of potential expansion themselves, even if it's not included in reserves yet.
Yeah, I think it's going to be hard.
I think Coeur d'Alene wanted to get something to lower their costs. And get some cash. So that was a good acquisition for Coeur d'Alene because it brought in cash and it reduced their average mining cost. So it was a good acquisition for them.
Well, a lot of these primary silver miners over the last decade, they've been transitioning more, buying gold mines or buying silver as a byproduct. So like 50, 60% of their revenues, sometimes more than that, up to 70, depending on metals prices, it was from either gold production or copper. So it was mixed in. So they weren't primary silver miners anymore. They had to do that to survive because the profit margins for gold mining for many years had been way better than silver mining.
No, that absolutely 100%. And also, as I say, because there just aren't that many primary silver mines. So, that was true. That's true of, as you say, it was true of Pan American. It was true of when Fortuna was a silver miner. It was true of Fortuna, but a majority of their revenue was gold, not silver.
Now, I want to transition to the royalty companies in Franco-Nevada. We were talking about Franco-Nevada a lot when it was between $110 and $120 a share, and people were panicking. I think the share price sold off 40% or something like that for Cobre Panama. I was saying the bad news was priced in. The market would eventually start to look at the company, outside of Cobre Nevada. That bad news would be heavily discounted. They would start to look at the free cash flow, the other growth, the other deals they were doing. Do you think that all the bad news is finally priced in at Franco-Nevada?
Oh, absolutely, 100%. In fact, I'll go even further than that. I think the probability of Cobre Panama coming back online at some point over the next 12, 18 months is now beginning to be priced into Franco-Nevada. So whereas 6 months ago we could say they had written it off and there was zero value for Cobre Panama in the stock, I don't think that's true anymore. I think some of that value is there, but by no means all of it. As you know, Cobre Panama was 20%, basically, 19% of their revenue and about 14 or 15% of their net asset value. But it was 20% of their revenue. That's not all priced back by any means. And, we're going to see Cobre Panama back. That's fairly certain.
And the share price has already rallied substantially. I mean, I was getting trolled by a lot of people that when I was talking that it was a value play at $110 to $120 a share. I mean, didn't it just hit $150 a share this week? So that's a substantial rally. And Adrian, that chart of Franco-Nevada, the 1 year chart, I mean, it's one of the best charts I've ever seen, the 1 year chart. It's retested support levels a number of times, and it looks like a clear breakout on there. It's just a beautiful chart on the 1 year for Franco-Nevada.
I agree completely. And from a fundamental point of view, you had a lot of Franco-Nevada was the number one equity that was held by generalist investors, right? And I think everybody knows what we mean by generalists, but non-resource specialists. And when they had the Cobre Panama fund, they just dumped the stock. It was like, here we go again. You can't trust gold mining stocks. And they just dumped it. And I think now you're beginning to see, with Franco having done well over the past year, but also with the sentiment in Panama changing a little bit, I think you're beginning to see generalists come back into that stock.
And we've talked about in prior interviews where Adrian's gone in depth about additional growth opportunities Franco has near term. I think they have a royalty on the Greenstone mine that just came online. They have other royalties on gold mines and silver mines coming online in the not too distant future. So there is other growth opportunities for Franco-Nevada. The market just ignored it for what,
Oh,
9 to 10 months.
absolutely.
Yeah, it was a huge buying opportunity, $110, $120 a share for anyone willing to think a couple years out.
Oh, absolutely. I couldn't agree more. And I'm not saying that I think it is grossly overvalued now or anything like that. As you say, I think it simply reflects the higher price of gold and the growth in the other assets that they've had. And now you're beginning to see generalists come back into the sector. I'm just saying that I think the resumption of Cobre Panama is priced in a little bit. It's not completely ignored at this point.
And the royalty companies, the larger ones, Adrian, they never trade for super low cash flow multiples normally or super low valuation. So like Wheaton Precious Metals, Franco-Nevada, because I hear people saying, oh, I only want to pay a couple times cash flow multiple for a business like that. I mean, the shares were down 40% with the bad news on Cobre Panama. I thought from a contrarian perspective, they were good risk reward value plays there. But you look at the other royalty and streaming companies, I mean, whether it's Wheaton Precious Metals, Royal Gold, Osisko Gold Royalty, they've had dividend growth lately. So yes, they're not value plays, but they're also growth stocks with free cash flow growth and dividend growth.
No, absolutely. No, I mean, I like to say that Graham and Dodd would not look at Franco-Nevada or Wheaton, but the high multiples are justified. That's the point you and I have talked about before. They're justified by the low risk business model. So, clearly there's a difference between earning a dollar, but having to pay 50 cents for it and earning a dollar and only paying 2 cents for it. There's a difference. And if you look at, again, I always look at things historically. If you look at Franco-Nevada, Bloomberg again is saying it's a 70 times price to free cash flow for last year. Now that's a little bit abnormal because you're looking at the price rally, $150, but you're looking at last year's free cash flow. But even if you take that 70, you go back 4 years, it was $135 and 135 times free cash flow. You go back 7 years, it was 112 times. So, I mean, even at these exalted levels, still not extreme levels by their own historic valuations. And that's true of Wheaton and it's true of Royal.
Well, also because of the business model, like you said, it's so efficient. There's so much diversification. The profit margins aren't going to go out of control unless a mine comes offline like Cobre Panama. I mean, I think we're going to see, as long as metals prices don't crash, I think we could see potential, not only free cash flow growth, but also dividend growth from a lot of these royalty companies.
Oh, absolutely. Because as the price moves up, acquisitions will start to be more expensive. And so you'll see companies do what they did from 2011, 2009, 2010 rather, for the next several years. I mean, Franco-Nevada went like 5 years without a single acquisition. As the acquisitions start to get more expensive, then the companies will stop doing those acquisitions, and that will only make their free cash flow even that much more significant. Absolutely. And they're always, the big ones are all debt free already. So that'll go to dividends. That'll go to dividend increases.
Well, Franco doesn't like to use debt, right? So it just depends on the management philosophy because Wheaton Precious Metals, they love to buy, they don't like buying royalties. The management likes to buy huge streams like either gold, silver, or platinum and palladium streams and use a lot of debt. But Franco-Nevada doesn't like to do that. They don't like buying the same types of deals with debt that Wheaton Precious Metals does.
No, they've used that, I think, twice in their history, and each time they paid it back. I'm subject to being wrong. It was about 12 months after they took on the debt. They paid it all back, maybe 12, maybe 15 months. So they've done it twice in their history, taken on debt and then paid it back very quickly out of cash flow. But the same goes whether it's royalties or streams. As the price of a commodity moves up, then the companies are not in such, typically painting with a broad brush, they're not in such a desperate situation for streams or royalties to be put on.
Yeah, I think you're seeing that. Well, in the past, you saw that with Wheaton Precious Metals. What for a number of years, the shares were stuck. If you go back and look at a max chart for Wheaton Precious Metals, because they had such a debt load, they bought all those assets, these huge streams. They're waiting for these things to cash flow during the bear market for the cash flow to come online and to start paying off the debt. And that took what 3, 4, 5, 6 years. And then afterwards, you got a huge share price appreciation and dividend increases. I would argue that Sandstorm Gold's going through the same type of period now, where they use a lot of debt to go buy these giant streams right now, and they just had the Greenstone Gold stream come online. Their free cash flow yields around 20%.
Right, right. Well, I'm not going to comment on Sandstorm because I'm not as familiar with that, but certainly all of the big ones. Yeah, you're right. I mean, the cash flows are just tremendous.
Well, I was just making the point, though, that for many years that Wheaton Precious Metals, the shares didn't do anything because they had too much debt on the balance sheet, and investors were worried about that. But if you bought when the share price was then, in hindsight, I mean, I've held the shares for over a decade, and now I'm up over 4x with dividend increases. So I'm sure you did the same thing. I knew the business was good. I knew they weren't going to go bankrupt.
Well, all of these, Franco, Wheaton, Royal, Cisco, they've all got tremendous growth already built in. You know, unless something goes dramatically wrong, as you mentioned, like Cobre Panama, but growth is already built in. None of these companies has to do another single deal to get growth. And this is a thing about, you know, a lot of investors, you've heard this many times, I'm sure, a lot of investors will say, oh, the royalty companies are so expensive. You know, they're okay in a bear market, you know, they don't go down as much as the miners. But boy, when gold's ripping, we want leverage. Well, these companies have leverage. Now, I would say that Franco and Wheaton are probably not going to be the number one performing gold stock. If gold goes up to $5,000 an ounce, they won't be your number one, but I'm willing to bet that they'll be above the average.
Oh yeah. Well, it's about risk adjusted return. So the person who's saying I got the top gold stock, well, how much risk did you take? Did you go and buy a gold mine where there was almost no chance of discovery, and all of a sudden the tax laws changed in that country and they discovered a huge gold mine and that was the top gold stock? It's about risk adjusted return.
Of course, absolutely. And the risk adjusted returns on the big royalty companies in a bull market are among the best out there.
Yeah, I think look, if the gold price stays at these levels or it goes to 3,500, I think, Adrian, the odds are pretty high. We're going to see $3,500 gold in 18 months or less now, given the macro conditions.
Yep.
At 3,500 gold, I don't see the cost for these royalty companies going up very much. I mean, that's going straight to the bottom line and the free cash flow multiple. That's a lot of extra free cash for management to do fun things with.
Yeah, absolutely, absolutely. But again, the point I will say is that if we have very strong prices, then remember some of the best deals that Franco and Wheaton did, both of them, were those streams that they did on base metal companies that had financial problems. So it was what they call a balance sheet repair, right? So they would go into Teck and BHP and the other base metal companies and say, we want your gold byproduct, and we'll give you a stream. Those companies are not in trouble like that now. So the opportunity to do those kinds of deals simply doesn't exist. Now, something will come along, something will happen. These companies, whether it's Randy Smallwood, whether it's Pierre Lassonde and David Harquil, not to forget Seymour Schulich, of course, these guys who run the big royalty companies, I think have been some of the smartest and most innovative people in the business, always thinking out of the box. And so I'm sure that in a few years there'll be, you know, we've gone from simply buying existing legacy royalties to creating royalties to balance sheet repair to, project financing for developing mines. You know, the industry has gone through a lot of iterations, and these guys, you know, I mean, Randy Smallwood was the guy that came up with streaming, which now we just take for granted. We don't even think of it as an innovation, but of course it was. It was a tremendous innovation, and we're going to see more of that in the years ahead.
Yeah, Nolan Watson was there too at Wheaton at
Yeah,
Silver Wheaton.
yeah.
Yeah, so him and Randy Smallwood were the two who designed that, and Nolan came up with the gold stream because there was only gold royalties. So, and then all the other industry has copied it. The industry is really doing a lot of financial innovation there. They basically replaced the royalty and streaming companies have replaced a lot of the banks for financing these mines.
Yeah, no, absolutely. And it makes, yeah, absolutely. I mean, the banks have become much more restrictive, and the royalty companies know and understand mining. So it makes logical sense. They're a much better partner now.
And the banks will come in later then. So the banks actually want to see the royalty and streaming companies provide a minimum layer of financing too. And then they'll come in afterwards with a smaller amount of debt in the financing package to finance construction of a mine. I think that's what's
Yeah,
happening.
yeah. Well, I mean, what you're seeing now, as you know, with most financing packages, you're seeing some equity, some debt, some stream or royalty. I mean, and all these things are just part of the normal package. Which one dominates depends partly on just the terms that you can get on each. If the equity markets are very strong, then companies are more likely, to raise equity. Um, if things are soft, then obviously, the streamers are still there. But every package now pretty much includes all three.
Yeah, and
You know,
I think that's way more efficient, Adrian. There's just so much risk with the debt because the metals prices drop and then cost of capital rises. I mean, these things, especially if it's variable rate debt or the metals prices drop, the miner could get in trouble if they take on debt or the mine doesn't come in on time and on budget. You've seen this with so many different mining companies. The
sure.
mine doesn't come in on time and on budget. I mean, now I just saw on a headline, Rainy River Mine for New Gold looks like it's doing really well, but I'm sure you remember back then the first like couple years that it was under construction, there were so many problems.
Absolutely. And of course, as you say, if a mine gets into trouble, it's the construction's delayed or something, and their cost overruns, and then the company has to go back for more capital, that extra capital is very, very expensive. And so getting all teams in is good, unless you're someone like well, anyway, unless you're a mining executive who simply just doesn't like streams, I think it makes no sense. I mean, the point I make to people is you're going to have to dilute. To build a mine, you're going to have to dilute. And you either dilute equity at the company level, you dilute the mine by bringing in a partner, you diluted the mine by bringing in a stream, but in some way or another, you're going to have to dilute. There's no question. And so it's just a matter of what's the most efficient at any given moment in the market.
Well, also like what is efficient then, and then the mine doesn't come in on time and on budget, and the miner is desperate. So then we've seen, I'm sure you've seen this many, many times. Either it's reverse stock split, share dilution, or the miner has to restructure that debt. And then that means what Franco-Nevada or Wheaton Precious Metals or Royal Gold has to come in and do a stream to fix the miner's balance sheet, so all the shareholder equity isn't wiped out and the miner doesn't go bankrupt. So
Sure,
yeah, this happens all the time.
sure.
Well, look at Argonaut Gold and Magino. I mean, the gold price was rising, and they still had immense problems with building the mine, and then that quality asset just falls right into Alamos Gold's lap.
Right, right. And then other assets, of course, went to Helios at very, very attractive prices.
Oh, that's a junior you like?
Yeah. I'm just saying that some of the Argonaut assets also went to Heliostar, the ones that Alamos didn't want.
Do you think that the assets Newmont Mining sold off to some of the mid-tier gold miners? Do you think that the mid-tier gold miners can run them better than Newmont did?
Um, I'm not so sure it's a matter of running them better, but I think it's a matter that they were too small or marginal, or in jurisdictions that Newmont areas that Newmont didn't already have a presence. And so from that point of view, yeah, they're just in better homes right now. I'd
As
put it that way, rather than say that they can run them better, but they're in better homes. People who will focus on those mines as opposed to Newmont, where they were orphans. Yeah.
Well, some of those mines were only what 150,000 or 200,000 ounces a year gold production for Newmont Mining. That doesn't move the needle. They don't even want that anymore. Those types of mines because what they're producing almost 5 million ounces a year. So that type of production and growth doesn't really benefit them at all.
Exactly. It's almost a distraction. No, I think Newmont actually did a good job in their disposing of assets after the Newcrest acquisition. I will say much better than the lousy job they did after the Goldcorp acquisition.
The market also liked SSR Mining. That's the mid-tier gold miner that bought what Cripple Creek in Colorado. They liked that they added an extra immediately producing gold mine in Colorado to diversify away from the production in Turkey.
Yeah, yeah,
So
yeah.
that deal, I guess you could say, since the share price for either company didn't collapse, it was kind of win-win.
True.
As we wrap up here, Adrian, I want to ask you about like IPOs or new royalty and streaming companies. There's another one. It's not publicly traded yet, but the rumor is they may go IPO by the end of this year. It's called Versamet. It's owned by what B2 Gold. It's owned by Equinox. Well, whatever Equinox Gold, the combined company is in Sandstorm Gold. They own the equity, and it has like producing royalties. Do you think that the market's going to be more receptive to these types of IPOs now with the gold price where it is?
Yeah, I think so. There's, as you say, there's a lot of new royalties in the works. In fact, there were three, not the ones you mentioned, as were sponsored by major companies, but three new ones I heard about at PDAC. I think the ones that are spin-offs from the major miners, like Mavericks was out of Pan American and the others. I think they will have a much more receptive audience because the mines are known and the mines are up and running. But yeah, I think we're going to continue to see more of them. But I think as the price of gold moves up, they'll have a very receptive audience
Those
if
will
they have
also be
real assets. If
those
they have
will
real assets.
Well, yeah, if they're producing enough cash flow, I mean, those would be acquisition targets too by the senior and mid tier royalty and streaming companies too.
Absolutely. Yeah. I think we'll see a replay of the Maverick story.
Do you think that that's why the larger companies like Franco-Nevada are kind of apprehensive to go and make a huge bid on the Origin or Altius Minerals, the Silicon and Merlin deposit royalties? Because those things are massive, but how many years away do you think they are from cash flow?
Well, first of all, we don't know that they haven't made a good bid. I think the biggest problem with the Silicon Merlin royalty is that the holders of the royalty, namely Altius and Origin, and Altius, as you know, Altius also owns 20% of Origin. So we'll say Altius is, if you like, the lead in this. They have 1.5% as opposed to Origin's 1%. But I mean, they have very smart geologists on their team. And I think the biggest problem we have with that royalty is that the holders of a royalty can clearly see growth, which is not just blue sky. They can see a path to much bigger ounces. But as you know, the major royalty companies don't like to pay for what's already known. So Franco has always said their mantra is, we'll give you a very fair price for what's known, and the blue sky is ours. The problem with Merlin is Silicon Merlin. If someone had made an acquisition just a year ago, they'd have been buying 5 million ounces. When Altius and Origin said, we know it's going to get bigger. And of course, it's now over 13 million ounces. So I don't know if I'm explaining that right, but I think there's a huge disconnect between what a Franco who pays for what's known now is willing to pay, as opposed to what the Altius people think this is realistically going to grow into. And yeah, because
Okay. Let me
Yeah.
try to make this a lot simpler for our listeners out there. So Adrian's talking about net present value, future discounted cash flows. So if there's only a 5 million ounces of resource or reserve, the mine would potentially be smaller. However, if the new mine plan is going to include around 13 million ounces, then the mine could potentially be larger. That 1% or 1.5% royalty, they're looking at net present value, future discounted cash flows. Then the seller of the royalty is going to want a much larger upfront payment. They're going to want to get paid an enormous amount of money based on those reserves and the projected cash flows. The issue I have with that, Adrian, is how quickly can this mine be built and come online? Because yes, I acknowledge that the mine is large, but if the royalty company wants to sell the royalty, and they want like way over $100 million for it, but it's going to take over a decade before it cash flows. I mean, most of the shareholders are going to be angry if a royalty company buys something that's not going to cash flow for 10 years.
Um, yeah, I'm not. I mean, I understand your point. Your point is correct, but I think, first of all, I don't think it's going to be a decade. Um, I mean, Anglo was talking about 2029. Now that's far too early. That's far too early, and unrealistic. I mean, they're going to build North Bullfrog first, well before they start construction at Silicon. And frankly, the problem is Silicons continue to grow, so they're not going to come up with a definitive feasibility study until they really know how big the thing is. I'm not sure that a Franco-Nevada or Wheaton shareholder, or Royal Gold for that matter, I'm not sure that they mind if a deposit doesn't come in for 10 years. I mean, look, when Royal bought Great Bear, that I think is 33, and they bought it in 23, right? Or 24. So that's almost a decade. This will probably come into production, I would imagine, 31, 32. So a little less than a decade. I wouldn't be at all surprised. I've said this publicly. I would not be at all surprised if Altius decides to hold their royalty. I don't think Altius is going to get the kind of offer that it wants for that asset. And I would not be disappointed at all. I'm a big Altius shareholder. I would not be disappointed at all if they decide to keep it, because it's a great asset. And Altius is a large, diversified company with cash flow. When I say large, I mean it's, $1.2 billion. It's not as large as Franco or Wheaton, but they've got cash flow coming in from diversified sources. They can afford to wait, just frankly, as Franco or Wheaton could afford to wait, but they can afford to wait for it to come in. So I wouldn't be at all surprised if Altius in the end decides to keep it.
Yeah, I'm also Altia shareholder, but their management tends to not want to hold those gold or silver royalties that they find, and so they want to cash out of them at a higher multiple, and then get cash or trade it for cheaper royalties and have a portfolio of lower cash flow multiples that they buy and accumulate. So they tend to want to sell the gold royalties at a high valuation and go and, as a contrarian investor, go and buy royalties on cheaper commodities at a lower cash flow multiple. That tends to be their management philosophy.
Well, they have in the past, you're right. But this one is so much bigger than anything else. This is so much bigger than any other gold royalty or gold asset they've had in the past. We'll see. I just don't think that, yeah, we'll see. I think they're going to hold it personally.
Yeah, and you mentioned the Great Bear royalty. I mean, like at the current price, at the current gold price, Royal Gold got a really good deal considering what they paid a couple years ago. So
Oh,
yes, they have
yeah.
to. So yes, they have to wait, but I think they paid 150 million cash. I mean, at the current gold price, net present value of that potential mine plan, I mean, that thing's worth hundreds of millions of dollars, and they only paid 150 million. So they were criticized at the time for buying that, but that if that was resold on the market, probably be at least $300 or $400, probably more.
Absolutely. No, I remember at the time, as you said, they got a lot of criticism for overpaying, and not just overpaying, but overpaying for an asset that didn't even have a feasibility or a resource estimate. People were saying, we don't even know how big it is, and they're paying this much. And I remember Bill, oh, I can't say his name, the CEO of Royal. He said to me at a meeting, he said, look, do you think gold is going to be higher by 2031, 2032? I said, yes. He said, do you think it's going to be significantly higher? I said, yes. He said, so I bet you in 2031, people are not going to be criticizing us for having bought Great Bear or Cortez for that matter. He said, in 2031, people are going to be happy we own those assets.
Well, also to
He
add
was
to your
right.
points there, Adrian, had they waited for a feasibility study and the mine plan, I mean, there's no way they would have won a bidding war with Franco-Nevada because I think Franco was waiting, and then there's no way they would have won the bidding. It's a similar situation in Kinross Gold buying that asset. Had Kinross waited, then what? They probably would have lost a bidding war with one of the larger senior gold miners too.
Sure.
So they were aggressive, and this time their big bet paid off. I mean, like sometimes those don't pay off, but this time it clearly looks like it did for Royal Gold.
Yeah, no, absolutely. But I'll never forget that when he said to me, do you think that in 5 and 10 years' time, you'll be happy that we own these royalties? And the answer was yes.
Well, it's in Canada, right? So it's relatively safe. And if you start running one on the current mine plan, net present value of future discounted cash flows, I mean, that royalty, the $150 million is going to look very, very cheap for a long life mining asset in a safe jurisdiction like Canada.
Yeah, no, absolutely.
And they didn't have any growth too. So now they have a really good growth asset. So it was a smart move back then. They're heavily criticized. This is the thing with these deals, Adrian, of this size, and you've been doing this a very long time. When you do a deal that large, normally people criticize the deal up front, but it takes a couple years to see if the deal actually works out or not.
Yeah, true. And of course, it makes a big difference. If you're a big mining company, whether you're Franco on the one side or whether you're Wheaton or whether you're Altius on the other side, if you've got diversified sources of revenue, then obviously you can afford to wait more than a company, that doesn't have existing revenue.
Exactly, and that's why I like the royalty and streaming companies, and I own like 4 or 5 different ones in my retirement account.
Yeah, it's my number one position by far, the royalty companies, yeah.
Well, I really enjoyed our discussion today, Adrian. I want to thank you so much for your time. If my listeners want to check out your paid newsletters or your asset management business, how do they do so?
Yeah, if they go to the website, adrianday.com, they can find information on both.